A warm welcome to all our viewers. This is the 8th session of Fundamental and Technical Analysis Trading conducted by SC Securities. So as always, today we will be presenting you some technical knowledge, how to use technical analysis for your trading purposes. And Mr. Saliya, who is our technical specialist, will take you through the technical training session. And what we are focusing today is how to use Bollinger Bands and parabolic SAR in technical analysis. Over to you, Saliya.
Thank you, Charitha. Okay, welcome everyone. Today, as Charitha mentioned, we will be taking you all through the Bollinger Bands and the parabolic SAR. And let's see how we can make use of them when we are doing, for our trading purposes. Bollinger Bands is an indicator that comprises of 3 lines, one in the middle, the other at the outer sections of that middle line, and it goes especially the middle line is typically the middle line is the 20 period simple moving average, and the 2 outer lines, one at the top and the other one at the bottom, are the give me a second, right? The outer lines, one at the top and the other one at the bottom, are a combination of the 20 period simple moving average plus the outer point, outer band or outer line, that is the upper line, is the combination of the 20 period simple moving average plus a 20 period standard deviation line multiplied by 2. The below line is the 20 period simple moving average minus 20 periods standard deviation into 2. That's how these lines are being calculated. And the reason as to why we are saying this middle line is the 20 period simple moving average can be seen if you add a simple moving average, 20 period simple moving average into the chart itself, and you will see that the middle line is exactly the 20 period moving average. If you increase it to 20, the length of the simple moving average, you will see that it overlaps that middle line. So basically, when we are looking at the Bollinger Bands, we call this the middle line, and this we call the upper band, and this is the lower band. The important feature of the Bollinger Bands is to understand the volatility when it is increasing and decreasing. As you can see, these two upper and the lower bands, they always come closer to the middle line and then moves away from the middle line. So when we see that they come closer to the middle line, we call it a squeeze. When it is moving away, it is expanding. So one of the strategies in the Bollinger Bands is that when there is a squeeze, we make use of that development to understand at which point to either buy or sell the security. You can see that at this level, the prices are trending alongside or on top of the middle line. At the same time, you can see that the upper band and the lower band are compressing towards the middle line, which is known as a squeeze. And once the squeeze takes place, we watch for a breakout in the price. If you can remember, we were discussing about price action, and in the price actions, we spoke mostly about the breakouts. So that breakout is very important. That breakout refers to the breakout when the prices are moving towards upside. A breakout has to happen from the previous one of the previous highs, right? You can see that there is a high here, and you can see that there is a breakout above that high. At the same time, you can see that there is a breakout or a crossover above the middle line, which is the 20 period simple moving average. If you can remember, when we were talking about moving averages, where we showed you the 12-day and the 26-day moving averages, and we were talking about two types of or two features in the moving averages that we normally look at. One was the crossover. The other one is either a support or a resistance. So here you can see that there's a crossover above. I mean, the price is crossing above the middle line. So that's another development that we look at when we are looking at this squeeze in the Bollinger Bands. Once that takes place, you can see along with the prices, where the prices are increasing with higher lows and higher highs, we can see that the upper line is expanding or moving away from the middle line. At the same time, the lower line is also turning upside, following the trend. Thereafter, we can see that the prices are moving away from the upper line. Now, some people think that this is an indication of the prices coming down. It's not the case. We are not using the Bollinger Bands to understand whether the prices are reversing or the prices are, when the prices are moving away from the Bollinger Band upper line or the lower line, doesn't mean that the security is turning to the opposite direction. That is not the case. You can say that it's an indication of when the prices are moving up. It's an indication of an overbought situation. But for that to happen, we have to look at other momentum indicators. But the reason as to why we use the Bollinger Bands primarily is to understand the squeeze and the expansion. And if we can make use of the squeeze and the expansion along with that breakout and the bullish crossover from the middle line, we can make use of this indicator very accurately and effectively. Another feature that we see in the Bollinger Bands is a thing called walking within the bands, right? So you have basically two when you look at the upper band and the lower band, you can see that there is a flowing band or flowing channel within which the prices are behaving, right? So that is known as walking within the bands. Most of the time, that happens, as long as the prices are not going beyond those two upper and the lower lines. In the case of the prices here in Expo Lanka, you can see the prices are walking within the bands over this period. So as long as the prices are going within a narrow range and the bands are also behaving within a narrow range, we can most of the time see that the prices are walking within the bands. Now, when the prices are walking within the bands, just like in any other indicator and any other, even based on the price action, if the range is very narrow, it's difficult to do any trades, except for the fact that you can make trades purely based on this purely based on the price range, right? If you can make use of the price range tool and understand when stock hits a low. I'm not referring to the Bollinger Bands itself, but looking at the low and compare that with the previous high and understand how much the upside potential is there within this range. Now, if you take this low against this high, you have a 32% return. So if you play with those, especially when a stock is going within a range, and if you are to use the Bollinger Bands to understand whether the prices are walking within the bands, you can make use of this tool and understand how beneficial these upper and the lower bands are to make short-term or quick returns, right? And if you analyze it in a methodical way, you will understand that there are opportunities even within the band or even within the channels that you can make a decent amount of returns. If you take a very narrow range compared, let's say over here, that's the low on the 19th of March, which is at 40.90, and compare that with this high that's on the 22nd of March, and this is the 19th of March and the 8th of March, I'm sorry, 9th of March, you will see a 20% return, right? So even if the prices are moving within very narrow ranges, where there is a lot of frustration, a lot of anxiety, a lot of emotion, negative sentiments being disseminated, talked about, all that. If you are an analyst, if you make use of these ranges, you will understand that you can make decent amount of returns more, on a regular basis, even when the prices are going sideways like this. At this, then you can understand that by using the Bollinger Band itself, you will be able to look at the squeeze, and then while the prices are within the bands, how you can make use of the present low and the previous high, and understand whether you can make a return out of it. And while doing that, you can wait for the next squeeze to take place and a breakout to happen. And if you, by looking at this chart over here, you had two opportunities where the prices moved into a very large rally once that breakout took place. And that's how we look at the Bollinger Bands. And apart from this, you have another important feature. The inventor of Bollinger Bands have really, advised or deliberated in his analysis. The primary, there are three primary reasons as to what three primary features that we have in the Bollinger Bands, or what that we can get out of the Bollinger Bands. One, as I mentioned, is the squeeze. The other two are to understand the M tops, how the M tops are reacting, and the W bottoms are reacting. In other words, what it means is that how the double tops are reacting or can be used for selling options, and at the same time, how the double bottoms can be used for buying options. Now, one example of a M-top or a double bottom, as the inventor of Bollinger Bands have mentioned, is that when one high in a rally, when one swing high is away from the upper band, like what we see here, and then the prices retraces into the band like this, and ideally if it comes to test the middle line. Now in this case you don't see that happening, but if you just go back, keep studying that M-top formation or the double top formation according to that concept, you will see that even if it won't come towards the middle line, that theory is effective. What happens is the first high, the swing high, is away from the upper band. Then the prices comes into the Bollinger Bands. Then there is a reversal after making a swing low. Then moves up again, rallies up, breaking above the previous swing low and making another previous swing high rather, and making another swing high. At that time, that swing high has to be inside the band, like what we see here. And then the prices retraces. And once the price breaks below the swing low here, the that downward or the downward reversal can continue. So a person who is in, especially when it comes to the international markets, especially in the futures markets or in markets where you have short, you can go in for short positions. That's one of the strategies that you can use by looking at the Bollinger Bands, where the moment a breakout takes place below this swing low, you move into a short position with a stop loss above, at any given area, ideally either this swing low or this, this swing high or this swing high. Even in our case, we can short our own positions, meaning we can sell some of our positions, thinking of buying back again by using that strategy. That is M-top formations. In the case of, that is the double top formations. The double bottom formations, you don't see that type of a scenario, but a double bottom interpretation is something similar to what we see here. There is a bottom here and there is a bottom here. Now, ideally, this bottom should have been below this line, and the prices moves up to into the band, and then when the next bottom, which has to be lower than this bottom, like what we see here, has to be inside the band. Now this outside the band, this inside the band. And once that happens, and if there is, after the reversal, this swing high, after this swing low, it rallies to make this swing high, which is the neckline. Here, the swing low is considered the neckline in that double top formation, and this is the double bottom formation neckline. That has to be broken. Once that takes place, you move into a long. But here you can see that that didn't develop. The neckline was not broken out. As such, the trend continued. So when we are using those strategies, we have certain rules to follow. Similarly, there are many such rules given by the inventor of Bollinger Bands when we are trading by using the Bollinger Bands. So you have, in other words, the most important feature in the Bollinger Bands is to understand the volatility. The volatility is low when there is a squeeze like this, or otherwise when the upper line and the lower line is, trying to meet the middle line, thereby, making a squeeze is an indication of lower volatility. Then when they separate from the middle line, that shows that the volatility has started increasing. So that's one of the major features in the Bollinger Bands. And also, as I mentioned, you can make use of the Bollinger Bands for those other strategies. Apart from this, I was wanted to touch on parabolic stop and reverse indicator. Parabolic stop and reverse indicator allows us to understand the entry and exit positions. In the case of the parabolic SAR indicator, you can see that the indicator which is marked here as dots, the parabolic indicator, when there is a reversal to the up, the parabolic indicator dot appears at the bottom of the price, and those dots within the periods will be following the price in that same direction, right? The prices are moving upwards. The parabolic dots are also moving upwards to the point where there is going to be a reversal and the prices come and touch the available dot. When that happens, it turns the other way around. Now here you can see that it came and almost touched, but there you don't see a visible parabolic breach there, meaning a stop. Parabolic SAR means parabolic stop and reverse, meaning the parabolic movement comes there. The moment the prices meet the indicator, it stops there and reverses to the other side. Now that reversal took place exactly here. You can see the dots followed the price trend up to here, and then at this point we can see that the stop and the reverse took place, and the dots started appearing at the top or above the prices, giving an indication of a downtrend. And the reason as to why I said that you can make use of the indicator to decide on the entry and exit points is that when there is a stop and reverse and you see the dot appearing at the bottom of the price, that means there had been a breakout, right? What is the breakout? The breakout is when we consider the dots or the indicator above the prices, right? There is a retracement towards the retracement, and as due to that retracement only, we can see that the indicator is at the top of the prices, and that can be also, especially when the inventor of parabolic indicator, when he invented, he mentioned that we can make use of these indicators or these dots as trailing stocks for international markets. You have a mechanism in the online software itself that you can select the trailing stop, and when the market is, let's say, reversing, this is a sideways movement, let's take this. When the market is reversing, these are you can go and short, and at that, or sell your own stock. At that point, you can make use of these dots as your trailing stop. In other words, if you, let's say, short here, the value that is appearing at this dot, which is 64.60, whereas the open of this is 60.90, and you can see the dot is at 64.60, right? So that is where the stop loss is entered, right? And then the next day it comes down to 63.69, like 63.70. Then the next day it comes down to 62.82. So basically, that trade, when we are giving a trailing stop, command, the each and every day or each and every period, that parabolic dot changes. The value of the parabolic dot changes alongside the market movement. So at the point where the price meet the parabolic dot, where to make a stop and reverses, at that point only the stop will be executed, and at which point we can understand that from the entry price you could have easily made a return just by using the trailing stop order itself. In Sri Lanka, we don't have the trailing stop order, but we have a thing called sell stop limit order, which is a manually done exercise. But we always can make at any given moment for each period, meaning for each day, we can understand where the resistance is and where the support is when we are at a trend. Especially if you come to the present situation, present trend, we can see that it's an uptrend for Expo Lanka. If by any chance the price reverses, right, the reversal happens and a retracement takes place, this is the level at which point the parabolic stop and reverse action will take place. That is at 70 rupees and 20 cents or 10 cents, right? So this, as far as the parabolic stop and reverse indicator is concerned, is the support. This is the level at which if it comes down to that level and meet or the price breaches that level, then the parabolic action will stop at that. In other words, the price, the indicator displaying below the price will stop and reverses for the indicator to appear above the prices, giving us an indication of a continuation of the reversal that would happen if the prices start falling to reach this parabolic indicator, right? So that is how we use the parabolic indicator. Simply put, where the moment you see the first dot appearing, you can get ready with a decision to buy into that counter. The moment a dot appears at the top of the price, you can get ready to sell that counter. The only drawback when you're using the parabolic stop and reverse indicator in isolation is when the prices are going sideways. Sometimes the moment it appears here, right, and you try to initiate a buy position here, you may not make a good trade just by looking at it, because when the prices are moving sideways, most of the time this indicator is not going to help us. Only at a time of a very strong rally, this indicator is going to benefit us. That is something very important for us to understand. When we are using these indicators, we have to understand the mechanism of that indicator. There are we know that there are certain indicators which can be used to understand the momentum. There are indicators which can be used to initiate entries and exits. So this is an indicator where we can initiate an entry or an exit. But as I mentioned, we cannot use that in isolation. The moment this takes place like this, we have to wait for a breakout. Since it is below the price, that means that is giving us an indication of a trend reversal, right? Or rather a reversal to the upside. So we have to wait for the other indications to confirm that. The next indication, most important indication, is that there has to be a breakout above the previous high. Now this is the previous high. This has to be broken out. Now here it broke out, but unfortunately that didn't continue. It got retested, and then you can see that the parabolic indicator moved to the top of the price line, right? So that is an issue that you have when you just use the parabolic SAR. This breakout needs to be confirmed with volume behavior as well, right? So when you're using the parabolic SAR, you have to look at the breakouts. The breakouts, one of the conditions in breakouts is the volume. The volumes have to increase. If the volumes are not increasing, still it is within a sideways movement. It can be a consolidation. So those are important factors to remember when we are using the parabolic stop and reverse indicator in order to make decisions of buying and selling. But it is a powerful indicator when we are using this with a indicator like MACD and the RSI, especially the MACD. If you take, it can be a powerful indicator. As I mentioned last week, this MACD indicator has two features. One is the center line break crossover, and the next one is the signal line crossover. So over here, when this took place, we can see that the blue MACD line is testing the zero line. It's neither crossing above the zero line nor crossing below the zero line. It's just going sideways. At the same time, these histogram values are also moving upwards. This is another very important indicator. The moment histogram values are moving upwards and moving above the zero line, that's a strong indication. But for that to happen, you can see it took place over here at the same position where the MACD line is neither going up nor coming down, making an indecision phenomenon, moving sideways, right? So for that, we take another indicator, that is the RSI, which we discussed last time. RSI, we take there, what we do is we look at the crossover above the 50-point mark within the body of, or the neutral zone of the RSI. The RSI overbought is above 70, this dash line, and oversold is below this dash line, which is at 30. For this strategy, RSI line has to go above 50 points. Right, now you can see the parabolic dot appeared here, but the MACD didn't confirm, right? So the parabolic dots are moving below the prices over here. At the same time, even the even the RSI is not giving us a confirmation because it's the same going sideways. Then the next important thing, as I mentioned, is the volume. Even the volume, you can see that the average volume is also reducing, and the volumes, the real volumes, are also not trying to go above the average level, right? So you're obviously, if you take a trade here, then it is more a consolidation, more an accumulation trade, but not a trade expecting a rally to the upside. So these are the things that we need to understand when we are using the parabolic stop and reverse. And since we took the what do you call, the Bollinger Bands also into this, if we take Bollinger Bands and include into this setup, like this, right, you can see that the prices are not, I mentioned that this middle line is the 20 period simple moving average that can be used for two reasons. One is the crossover up and down, or otherwise the support or the resistance. At this point, we can see that there is no crossover. Tried to cross over here, but failed, and the middle line, or the 20 period simple moving average, is acting as a resistance line. So in this narrow range, it's a resistance that we can see, by looking at the simple moving average also. So basically, those are the things that we need to understand when we are making use of the parabolic stop and reverse, the Bollinger Bands. And since that we have taken all these indicators and trying to find out at which point to buy or sell, you need to wait for many confirmations. This, especially in this setup, I would prefer to wait for the histogram bars to move above the zero line. Histogram bars to move above zero line, and then to see the RSI going up above the 50 points, 50 point mark. MAC, the prices crossing above the middle line. Then the parabolic SAR also has to give us a buy signal, right? At this point, we will be understanding whether there is a breakout, not only by the crossover above the simple moving average, whether there are breakouts here, right? So important thing in a scenario like this is a continuous operation. When we make use of indicators like this and wanted to take trades, it's a continuous operation. You have to continuously put these rules into action, right? If you have buy rules, continuously you have to have those buy rules going. At the same time, continuously you have to have your sell rules going. If you and the other important thing is, if you manually do this, then you have to have your own watch list. You have to decide, okay, these are the 10 stocks or 5 stocks that I want to make use of this setup with trading buy rules and the sell rules, and this is how I'm going to do. Every day you have to look at those counters and understand the ones which are giving you this opportunity of making a trade. Once you do that, there are, when it comes to a sideways movement, you have to immediately give at least, let's say you're buying 10,000 shares, at least 25% or 50% of your position has to be immediately entered into a sell order with a minimum return on investment. Otherwise, you're not going to make the maximum use of this. If you're waiting for that reversal to happen and your sell rule to take place, because in a sideway movement, the sell rule derived by these indicators will not help you. Example is here, if you take the simple moving average, the crossover is here, right? But the parabolic SAR is here. So basically you have to buy at this level. At that point, you can see there is a small spike, or rather a bleak improvement of volume. So that's not a very strong signal, right? But even then, if you are going to take that call here, you enter at, let's say, at 46.20, which is the closing price, and then on the selling side, you have to have those rules repeating, meaning the parabolic SAR has to appear at the top of the price. Then the price has to cross below the signal line, or rather this middle line, and then the MACD has to come below the zero line, and then RSI has to be below 50 points. So when all that happens, is something like here, right? So you buy now that closing price is 47.80, but you bought at 46.20. So when you give the two-way brokerage, you will not be able to make money out of it. But if you look at this and give a minimum margin, right? You can make use of whatever the minimum margin. Here you have 17% return. It's a 17% return. So a minimum margin can be 1%, 2%, 3%, 5%, whatever the percentage, right? And then you look at annualizing it, right? If you make, let's say, from this 46.20, if you sold at this level, that's an 88% return in a matter of about 3 to 4 days. Let's say even within a week, you made 8%, or take that 2.5% away, you will have 6% roughly, right? 6% for 1 week. 6 into 4 gives you 24% per month into 12. That's 288% for a year, right? That's how you have to look at when you are trading like that, right? Some majority of the traders, they try to wait for the long haul, right? So whether you're going to wait for the long haul or not is up to every one of us. But if you make use of these, little profits, that's why I said, even taking selling the entire position of 10,000 shares, at that point, you make 8% for that, or rather 6% for that trade in a matter of 4 days, right? So you don't need to wait for that risk, right? You don't need to wait for the risk of not making money to happen, right? So basically, when we are using strategies, if you program, you can program this, right? In other markets, there are facilities given by those online trading systems itself for us to program by using all these indicators, right? But you can experience is that when there are very strong rallies, these indicators are giving you fantastic returns, right? These, I'll give you one example. Take just the RSI, right? Now RSI, some people, now this is something that I'm always telling, right? RSI, when the RSI moved above 70 points here, that was on 31st of December for Expo Lanka, the stock was trading within a range of 2870 to 2930, right? 2870 to 2930. Then when the RSI went up, did all the all that action and all the fun, right? When it came back again to 70, it is between 54.50 and 69. Here 28.70 to 29.30. Here 54.50 to 69. So you take even the other indicators. Here you have the first dot, right? I'm talking on the 70 points. You have the first dot here. Volumes are increasing. MACD has increased, right? Everything has happened, right? That is at 70 points. So you can even make use of this trading rule at 70 points itself, right? And then you need to have the minimum ROI. That is very important, right? The moment, thereafter you can make use of, like from here, if you use this tool, you will understand somewhere at this point, right? Up to this, that is in a matter of 2 or 3 days, you are talking of 12%. Then here, it's 106%, right? At that point, RSI is at 78. Over here, RSI is 83, right? So and you're talking of 126%. If you, if you program or if you include the percentage return also into your trading plan, you will get really rewarded. At the same time, your success rate is going to increase, right? Rather than just buying and waiting until it hits the maximum, right? Today, I can remember one of my clients who has bought Expo Lanka. He has put orders at 85 rupees and 87.50, right? He told me to put an order at 85 rupees. He has put 87.50 or something. And before trading, he was thinking to him, he was talking to me and saying, what are we going to do if it goes and hits 85? Are we going to sell? He doesn't know whether he wants to sell even at 85 rupees, right? But if he had programmed, or otherwise he planned to put that into, put the return on investment into of the plan, he won't regret it, right? Because today's price behavior also, if you take, it's a range between 77.20 and 81.10, right? But yesterday it was between 75 and 80. Still, we are better off compared to yesterday, or at least we have come within yesterday's price levels. So these are the little things that you need to understand when you're doing your trading or investments. You see, if you're talking of getting 12% in a matter of 1 week, right? Everybody, you are up on the deal compared to the fixed deposit rates that are available right now, right? So that's the way you need to look at the market. And thanks to technical analysis, this price action and the tools that we have at our disposal, you can succeed if you do it, if you have a good plan, and at the same time, if you do it regularly, right? You need to keep your book. You have to have the habit of bookkeeping on a continuous basis if you're doing that, right? So rather than waiting for the maximum to happen, right? If your strategy is like this, you are going to get rewarded, and it will be not only a rewarding thing, it will be a fantastically satisfied experience also. So with that, I will end today's program. Hoping to meet you all again next week with other indicators, a few of maybe a couple of another indicators, and then we are moving into using one of my favorites and the most successful for me, the indicators in the tools that you have here. That will be probably week after next. But if you all wait with us, we will take you all through how to do, how to make use of them for your training to be successful. Thank you very much.
Thank you, Saliya, for that excellent presentation. So we will be starting the Q&A session shortly. Be tuned.